I'm Professor Ebert, and I'm here to help you master it quick. In this session, we're going to look at how to take the information in a transaction and make a double-sided journal entry with it. You'll see how the information in the journal entry ends up being amounts on financial statements in a company's annual report. First, again, a couple of ground rules like we had in transaction reporting. You remember the transaction changed at least two accounts. So when we use a journal entry, our journal entry will always have at least two accounts in it. Secondly, when we were changing the balance sheet with our transactions, we did it in such a way that it stayed in equilibrium. How we're going to do that with journal entries is by having the same money on either side of the journal entry. You'll see. In our session on transaction recording, you'll remember, we looked at 6 different types of accounts. In the double entry system, these accounts operate this way. Asset, dividend, and expense accounts are the type of an account where a debit entry will increase the account and a credit entry will reduce it. Liabilities, capital, and revenue accounts work the opposite way. A credit entry will increase those accounts and a debit entry will reduce them. Now, those of you who might be up in Latin will realize debit and credit are Latin words. Debit is a Latin word for left, meaning the entry goes on the left side of the account. Credit is a Latin word for right, meaning that the entry goes on the right. Why Latin words? Remember, double entry accounting was invented by Friar Luca Pacioli in the late 1400s. He was a Roman monk, mathematician, and he conceived the system that we still use to this day of double entry accounting to record business transactions and resulting amounts that we can use for financial reports. Now, as we did in transaction recording, we'll have to identify the accounts which are going to be changed by the transaction. We have an extra job to do in that we're going to have to also identify the direction we would like them to be changed, whether we want them to be increased or decreased. Remember, the first transaction the business will get involved in is when it's first formed. There'll be investment from the owners bringing assets into the company. The assets are oftentimes cash, but they could also be equipment or cars and trucks or buildings or any other type of an asset. Now, remember what the substance of that transaction was. When the asset came in, we increased the type of asset being invested in, and we also increased the owner's capital account. So we changed an asset account up, and we also changed the capital account up. Okay, so for a double-sided journal entry, what we want to do is increase, and we'll say that the asset cash is coming in for $10,000. To get that account to increase, we'll use a debit entry. The second account we wanted changed was the capital account. We wanted that to be increased as well. Now, we'll presume for a second that our business here is a corporation, so I'm increasing the common stock account. In our journal entry, the debit account will always be used on top, and the entry will appear immediately beside it. The credit entry will be on the bottom with the amounts and the entry slightly indented to the right, such as we have here. Now, if you notice, I have the date listed in the upper left-hand side, and the reason for that is that's the date that you would like to change to take place in the accounts. You might say, well, why bother with that? Aren't they all the same? Actually, there could be quite a bit of difference between December 31st of one year and January 1st of the next year. So the date when you'd like the account to change to take place is actually very, very important to have. The second transaction we looked at in our previous session was when the business purchases assets. And if you recall what we talked about, there are 2 possible forms, one involving a cash payment at the time of purchase, and the second one involving a credit source, accounts payable. If we purchase our asset using cash, the asset we're purchasing goes up and the cash account drops, so the change is inside there. So let's suppose we bought a truck for $5,000. The asset truck would increase, so that'll be a debit to the truck's account. The asset cash will decrease. That's a credit to the cash account. Had we put our truck onto a note instead, the transaction would be slightly different. Instead of reducing another asset, we would have increased the liability note payable. Now in that case, we want the asset truck to increase by $5,000, but we also want the liability note payable to increase. A liability account is a type where a credit entry will do that for us. In the case of a larger asset where we paid some cash, if you recall, we had 3 accounts involved. The asset we bought increased, the cash account decreased, and then there was a note handling the rest of the transaction. Let's say our company bought a whole group of trucks and paid $50,000 and put some cash down towards the purchase and then used a note for the rest. Up top, we would have the trucks we're buying increasing, the cash account decreasing, and then the note increasing. So let's say that these are $50,000 worth of trucks. So we want to increase the truck account $50,000, so that debit entry will do that for us. We also put $10,000 cash down, let's suppose. So we want to decrease the cash account by 10. The rest will be taken up by our note payable for $40,000 in this case. Had the company bought a building, it would be very similar. We would debit the building, credit cash for the down payment, and then use mortgage payable for the note. In the case of paying a liability, we want the liability we're paying to decrease, and the cash account will also decrease. The transaction effect of that was a reduction to the liability we were paying and a reduction in cash. How we'll put that into a journal entry is our debit is going to be to the liability we're paying. Let's suppose that in this case we're paying an accounts payable for $2,000. A debit entry to accounts payable will reduce it, which is what we want. The second account involved is going to be the cash account, and it also should receive a decrease. To get an asset to decrease, we'll use a credit. The good news is all liability payments will follow that same general pattern. One way the company has of acquiring assets is to use debt. In cases where the company uses debt to buy something, we will have an increase to a liability account and also an increase to the cash account, representing the cash that we borrowed. Now, in the transaction that we looked at in our previous session, we increased the cash account and we also increased note payable. The cash account was over here in the asset section. The liability note payable increased as a result of our borrowing. So the journal entry to show this will be a debit to cash. Let's suppose that our journal entry is for $25,000. We're increasing the company's cash account by $25,000. How did they come to get it? They borrowed it from a bank. So the credit to note payable will handle the borrowing for us. Now, all liabilities have to be paid at some point in time, and let's suppose that this note has a periodic payment that has to be made. The payment will contain repaying some of the principal on the loan, also interest during the period of time the loan was out, and of course a reduction in cash. In such a case, we will actually need three accounts. We're going to reduce the note, which will be a reduction to the liability note payable. The expense of the interest is also going to cause capital to drop. Remember, whenever you drop net income, capital will go the same way. And of course, a reduction in cash. So the transactional effect of that was a reduction to the note, interest expense reduced equity, and then cash also dropped when we made our payment. So our journal entry will contain debit to note payable, for the sake of our example here, let's suppose the interest expense was $250. Interest expense uses an expense account, so that'll be a debit to increase that. Then the amount of the money we have to pay to the lending institution will be the total of both of those. Cash will be credited $25,250. And that represents a recording of an installment note with interest. When the company wants to take a withdrawal or a dividend, the effect of that will be a reduction in capital and also a reduction in cash. Now, in a previous session, when we looked at publicly owned corporations, there was also the possibility of needing to use dividends payable while we located the new owners of the shares and then paying that liability off subsequent to that. In the first case, the declaration of the dividend will reduce the capital section, and then we'll assume it's paid the same time, will also reduce cash. Transactional effect of that was a reduction to owner's equity because retained earnings dropped, and a reduction of cash. Remember, the dividends account operates with a debit. So when we debit the dividends account for this, let's suppose it's $500, our credit to cash will be for the same amount. Now, in the second case, where it was a dividend payable used, the top transactional effect was a little different. The cash hadn't dropped yet, so we used dividends payable in the liability section. How the journal entry will handle that for us is it'll make use of that liability account, dividends payable. Remember, a liability account is a type of an account increased by a credit entry. Then later, when we actually send the checks out, it's nothing more than paying off a liability. We'll debit dividends payable to reduce it, and also reduce cash with a credit entry. In the case of a proprietorship or a partnership, it's very similar. They wouldn't use the dividends account, they just would use a drawing account, and the cash payment would be at the same time. When the business goes out and earns some money by doing work for a customer or selling products to a customer, as you know, that uses a revenue account, and the direction of the change will be an increase to the revenue account. Remember, anytime we increase revenue, we're increasing net income, so capital will go up. So the transactional effect of that was an increase to owner's equity. In the case of a corporation, it's because the retained earnings is being increased. Remember, every revenue transaction will bring us an asset of some kind. The asset might be cash, might possibly be accounts receivable. In the instance of cash, our journal entry to record this will be a debit to cash and a credit to the revenue account. The debit increasing the asset cash, the credit increasing the revenue account. So suppose that transaction is $300. Both sides of the balance sheet would increase by $300. Due to the fact that we followed our ground rules. We used two accounts. The money on the debit side was equal to the money on the credit side. As long as we do that, we'll never throw the balance sheet out of equilibrium. Now, if it were a larger revenue transaction and accounts receivable was involved, The accounts receivable would receive an increase rather than the cash account. The transactional effect is just the same. The asset section would increase, it's just a different asset. Now remember, when the customer pays us, we're not having a second revenue transaction. We've already taken care of the revenue effect with our recording of this one. When the customer pays us, we only have to record the receipt of cash and a reduction of accounts receivable. So when they pay us, we'll increase cash and reduce accounts receivable. If you remember the transactional effect of that one, it was entirely in the asset section. The asset cash is increasing, the asset accounts receivable drops. So we don't have any revenue effect at all when we collect an AR. If the company uses up expenses, and they always will in the performance of their work, remember how we handled the transaction for that. The expense account being used is to be increased, which in turn will cause net income to be decreased. For that reason, we showed the transactional effect of that as a reduction to the owner's equity, the reason being because net income is dropping. Now, in the case of an expense paid for in cash at the same time, there will be a reduction to the asset section. So that type of a transaction would appear this way. Let's say it's a utility bill. Utilities expense. If I debit utilities expense, I will increase the account, which will produce the drop to net income. If we paid it at the same time, the credit account will reduce cash. Now, as you know, businesses don't want to pay accounts payable until they're due. Anytime somebody extends credit to us, they're basically giving us an interest-free loan, so we want to make sure we take advantage of it. So what we would probably do is not pay the electric bill immediately upon receipt. We would use accounts payable. The increase to accounts payable would keep the transaction on the right-hand side of the equal sign up there. And in terms of the accounts we would choose, we would credit the liability, accounts payable. When it's time to pay the accounts payable, probably 30 days or so later, we simply debit accounts payable and credit cash. So it's important to notice, when we pay a liability, it's not a second expense. We already took care of recording the expense the first time. We're simply paying off a debt. So those were the basic transaction journal entries. To summarize, every time we made an entry, we used at least 2 accounts, sometimes more, but always at least 2. Also, when we chose our accounts, we were mindful of the direction in which they were to be changed. If they were asset accounts, dividend accounts, or expense accounts, that was done with a debit entry, and a credit entry reduced them. If we wanted an increase to a capital account, a liability account, or a revenue account, we used a credit entry for that, and meaning a debit entry would reduce those. The money we used, the total debit money was always equal to the total credit money, and for that reason, the balance sheet remained in balance. Now, where does the information go from a journal entry? What happens is it goes to the general ledger account that we used in a journal entry and either adds to the balance in the account, if that's what we wanted, or reduces the balance in the account if we wanted that instead. Nowadays, that is done electronically in a process known as posting. The accounting software does that for us. So when you look in the general ledger of accounts, what you're seeing is the ending balance in each of the accounts and all the transactions that brought that balance to be. Next comes what's called an unadjusted trial balance, which will be an arrangement of all the ending balances in the accounts. The accounts where a debit entry increases them, assets, dividends, and expenses, will have a debit ending balance. If they don't, it usually means there's something wrong with the account. So it's a diagnostic if it has the wrong balance in it. The accounts where a credit entry increased them, capital accounts, meaning capital stock if it's a corporation, paid in capital, retained earnings, those accounts, they were increased by a credit, so was liabilities, and so was revenue. So likewise, they'll have credit balances on them when we arrange our unadjusted trial balance. If they don't, again, something could be wrong with the account. Once we have those balances, we're looking to see if the total of all the debit accounts is equal to the total of all the credit accounts. Now, if it's not, it's usually because of one of the following issues. When we were posting to the account, we might have simply brought the balance over wrong. It's very easy to bring 513 over as 531. That's called a transposition, and that'll cause the amounts to not match. Another mistake, which accounting software makes less likely to happen, is called a decimal slip. If I bring $513 over as $51.30, that will also cause the amounts to not balance. So the amounts on the bottom balance, it means that when we journaled, we had equal debit and credit money. When we posted arithmetically correct. And when we brought the balances over to the trial balance, we didn't flip any numbers. Now, does that mean that everything is perfectly good? Unfortunately, no. There are still a couple of errors that can happen and not show themselves by having the totals not match. One of them is if I use the wrong kind of an account. If I don't understand the difference between a truck asset and truck expense, and the company buys a truck and I debit truck expense instead of trucks, the trial balance will not be thrown off by that. Why? Both of those accounts function the same way. The second thing I could do is I could make the journal entry backwards. If I'm buying a truck and I don't understand how a debit account, an asset account works with debits, and I debit cash and credit trucks, the trial balance thinks I sold the truck. It won't be out of balance by that. The biggest failure of the accounting system of all is a transaction happens and we don't have it recorded. And that might seem very strange to you, but in real life that can happen very easily. If you have a closely held business and the owner does something and doesn't tell anyone else that he or she did it, that transaction is not recorded anywhere, and that could be a very serious problem. So once we have the information and we make our journal entries and we follow our debit credit rules and get our unadjusted trial balance, we're most of the way there. We're not ready to make financial statements yet. There's still an adjustment process, which we're going to see in a different session. But once we reach that point, we're on the way. And once you understand how that works, you're on the way to mastering it quick. I'll see you next time.